Hi, I'm Sameer Jain, founder of ActiveAllocator. As we now make the transition from a startup to an early stage company with enormous potential for reimagining wealth tech, I take great pleasure in introducing our firm to you. Let me share with you our mission, the huge investment problem we address, as well as provide some color on our evolving industry so that you begin to get a sense of who we are, what we do. We're also looking for early adopters, investors, as well as folks we can partner with. So if this is of interest, do get in touch with me. We aim to reshape the wealth management industry by resetting advisor and investor expectations about asset allocation advice, where the best advice comes from, what it should cost, and how it is delivered. We know how to increase expected returns for 35 million investors by eliminating the 30% plus loss that's built into the way the retail financial advice and investment management industry is currently structured. Our technology removes the deadweight costs of over 130 billion in just strategic asset allocation inefficiency, and it also drastically reduces the 300 billion that's being paid in advisory fees. What's really ambitious is we do it one individual portfolio at a time. Let me tell you what the problem with our industry is. The problem is traditional forms of creating and delivering asset allocation advice are costly, inefficient, and impersonal. Costly because financial advisory fees automatically destroy over 20% returns on investor capital year after year. It's inefficient for we can now near conclusively demonstrate that bad asset allocation decisions straight away destroy another 10% from return on capital. So this is an egregious 30% value destruction in returns every year. This needs to stop, period. It's impersonal because financial firms just can't provide personal advice to everyone profitably, and the reality is few customers want to pay for advice. So to serve a broader audience, financial and robo-advisors put retail investors in what is called model portfolios, which don't work. They don't account for personal investment views, preferences, limitations. Worse still, clients never really know how inefficient their allocations are. So all this changes with ActiveAllocator. So what is our solution? We help investors analyze existing allocations, discover inefficiencies, and create a bespoke portfolio in 10 minutes, in 10 clicks, and at 10% of typical costs. I'd like to believe that we are the world's first and only portal that seamlessly and more important, correctly integrates traditional, illiquid, and alternative investments, private equity, real estate, hedge funds, managed futures, private debt within portfolios. So the question is, how do we do it? Well, what we do is we aggregate an investor's in-house and held-away accounts at over 15,000 financial institutions across the US and Canada. Then our proprietary technology searches, recognizes, classifies, and instantly maps more than 4 million financial instruments to 50 granular asset subclasses, and we do it in milliseconds. So by doing so, we shift the focus from financial products to asset classes, which really drive long-term portfolio performance. Another thing we do is we allow users to compare and validate their own market views with capital market assumptions from 10 Wall Street firms. After all, nobody has monopoly on investment outlook. We are all about depersonalization, constraints on specific asset type exposure, aversion or preference for illiquidity, for alternative investments, as well as expressing a dozen other choices. So our approach to optimization is far ahead of those around mean variance optimization and dated modern portfolio theory. And to implement, we give you the ability to securely execute transactions across a dozen broker-dealer firms. The question is, why now? Well, there are many reasons. The financial advice, retirement, wealth management industries have been spared convulsive change, and they have been insulated by an older demographic, regulatory barriers, and very high capital requirements. However, the forces of digital disruption that have ripped through news, music, travel, and other industries are now poised for a frontal assault on wealth management, and we want to be the guys that lead this assault. The other thing is wealth tech disruption. Conditions have become much more favorable now. Consumers are ready, industry conditions favor innovation, and the technologies, or at least the ones that we use, that is required to transform the financial services industry finally works. The second piece to this is regulation-driven changes from rules that are intended to eliminate conflicts of interest. So, although much uncertainty remains around this, the genie is out of the box. The third piece to this is technology-driven personalization across most industries, and we bring this to financial services. The other piece is the increased adoption of alternative investments by affluent investors. So large asset management firms with huge distribution systems continue to introduce new investment products, which has increased retail investor access. So we've invested 2 years with multiple quant PhDs to develop the data sets and algorithms needed to correctly include these in portfolios. And I'd like to say nobody does alts better than ActiveAllocator, and I say it with some modesty. In fact, we have an opinion of counsel from the country's probably most prestigious ERISA law firms that supports this. The fifth thing that's happening in our industry is, and that's something we do very well, is catalyzing financial advisor migration to independence from wirehouses and captive channels. I believe our system is smarter than any wirehouse or wealth management firm out there, and I know this because I've been there, done that. Sixth is the new propensity to buy versus build in-house by mid-sized financial firms. And of course, these days, no conversation is complete without mentioning major technology shifts, cloud-based services, low-cost and open-source software development tools, as well as partnering across the digital ecosystem using APIs. We catalyze strategic asset allocation that can be self-directed, advisor-driven, or collaborative at the advisor's discretion. So unlike prevalent digital tools, we convey the richness and the nuance of human judgment. We tell the individual investor, trust your financial advisor, but do verify with us. Think of us as a second opinion. And just to be doubly sure, challenge your financial advisor to facts. Test your existing portfolio to see how good a job your advisor has been doing for you. Perform custom on-the-fly analysis in seconds. So our prospective customers, outside individual self-directed investors, will include a subset of around 30,000 RIAs and 200,000 plus independent financial advisors at small and mid-sized broker-dealer firms, as well as advisors attached to employee model captive channels such as regional banks. Also, we are in conversations with large asset management firms, banks with wealth management divisions, foundations, endowments. How do we create value? Well, our model is to blend the human with the digital. Our platform fosters advice that is collaboratively arrived at between our clients and us. So our approach is to augment advisor-client interactions by bringing in analytics-driven, fact-based, product-agnostic thinking. For financial advisors and RIAs, we enable deep personalization. In an era where money can be managed effectively, efficiently, cheaply, ActiveAllocator helps advisors move up the value curve. We provide a modern digital advice experience. We recognize that the market of one is the new norm, and we drive the individualization of every aspect of asset allocation down to the level of a single client. Let's talk about competition. Well, one is software companies, old world established financial software firms. As these have morphed and grown, have become all things to all people, and their offerings are geared to providing the applications and services financial advisors use to manage their practices. What they do is workstation-based deployment for data aggregation, for analytics, financial planning. Some offer rudimentary portfolio management, trading, rebalancing, performance reporting, portfolio accounting, CRM, billing, calculations. Some also offer basic research and due diligence on traditional investment managers and funds. So in general, most of these seem to compete closely without any clear source of differentiation in content. Most are just plain vanilla tech firms with very little investment content, and if I may use the word, but masquerading under fintech to improve their valuations. Extending simplistic asset allocation and portfolio construction views has also led to a proliferation of a new genre of undifferentiated robo-advisors who decry the benefits of active management. In doing all this, most have lost sight of the single most reason that a client reaches out in the first place, which is to create better investment outcomes. So we differ from digital money managers, digital investment managers, and most digital financial advice providers. We also differentiate from emerging robo-advisors that create simple, low-fee, diversified, automated ETF portfolios, largely targeting naive, mass affluent investors. The other lot is wealth management firms. I keep hearing about wirehouses and wealth management firms as formidable competitors. Yes and no. Yes and no. Most of these firms provide bundled asset management, wealth planning, investments, fiduciary and risk management services, and they are one-stop shops. I believe that unlike them, our advice is independent and objective. We do not draw revenue from soft dollars, commissions, captive broker-dealers, referrals. Often these firms are self-focused, driven by firm profitability, legacy operations and approaches, with their process largely limited to the firm's products or deriving revenue from third-party products they distribute. All of them have a standardized product sales orientation, while we are product agnostic. Most of these firms lack comfort with non-traditional asset classes. Our approach, by contrast, is built around building liquid and traditional investing together. We are not wedded to products, for we are solely driven by allocation and portfolio construction advice. We support multiple asset management platform providers for fulfillment, bringing benefits of multi-asset, multi-product inclusion. We expand the investable universe to over 50 asset subclasses. Let me now turn to our team. Our team has complementary asset and wealth management, investment banking, software development skills. Collectively, we've allocated billions of dollars in client capital. We've run large businesses. We've served both institutional and retail investors across the world, and we've published extensively. Our investing team members have held MD roles on Wall Street with AR Capital, UBS Alternative Investments, Citi Alternative Investments, Baird and Company, Morgan Stanley, RBC, Paine Webber, Shinsei Bank, Deutsche Securities. We also bring top-tier academic credentials with multiple degrees from MIT, the Fletcher School at Tufts, Technion. We have PhDs, CFAs, CPAs. So the whole is greater than the sum of the parts. Let's talk about our status to conclude. Over the past 2 years, we've formed our team, we've validated the market potential, we've invested our own as well as raised external capital that is needed to execute on our business plan. We've built an enormously sophisticated product engine. We have a lot of valuable IP. You can see that on our website. We've exhibited thought leadership, we've participated in industry events, and we have entered complementary product and partnering alliances. We've had success with trial customers and are now being used to manage large amounts of high net worth investor capital. We are beginning to attract industry attention and were featured last year by a leading fintech West Coast Investment Bank as an emerging wealth tech disruptor. So now we are going to go for growth. So we've started identifying key prospects. We've started having preliminary sales conversations. And we've been fortunate to meet with early success. And I hope these pilot projects will convert into revenue generating opportunities. So as we grow, we require early stage financing to build on our early success, to invest in product development, in gaining market traction, in demonstrating revenue growth. So if any of this is of interest to you, do get in touch with me. Thank you so much for listening in.